Welcome to Iron Financial, the channel that helps you forge a stronger, tougher portfolio. Today, we're putting on the hard hats and grabbing our clipboards for a full-blown structural inspection of the Hershey Company. Now listen, on the surface, their latest numbers look absolutely rock solid. We're talking a massive earnings beat that had the stock climbing. The whole structure just looks impeccable from the outside. Whoa, hold on there. Before we declare this thing a masterpiece of engineering, let's ask the real question. Is that just a fresh coat of paint hiding some deep foundational issues? Is this just a temporary sugar high, or is there actually some real steel in this company's framework? I need to know if this is a solid investment we can build on or a property we need to slap a condemnation notice on. We're going to dig into their Q4 earnings, get past the shiny headlines, and deliver our final verdict. Let's get to it. Okay, so let's start with what I call the official curb appeal. This is the big, bold statement from the new president and CEO, Kirk Tanner. You hear those words? Strong conviction, momentum. These are powerful, confident words management absolutely wants ringing in your ears. It's the kind of statement that's designed to project unshakable strength right from the get-go. Exactly. It's the perfect photo for the sales brochure, designed to make you fall in love at first sight. It is pure marketing 101. But look, as any good inspector knows, you never ever judge a building based on the promises they make in a glossy handout. You got to get inside. You got to get past that pretty facade, find the load-bearing walls, and start checking them for yourself. That's where you find the truth of the matter.
And this right here is our blueprint for today's inspection. We're going to start with the sweet headline beat, just to really understand why the market got so darn excited. But then we're going to start tapping the walls, looking for any cracks in the chocolate armor. After we've assessed the damage, we'll see if the salty steel reinforcement is actually strong enough to carry the weight. Then we'll review the company's own blueprint in forging the 2026 outlook. And after all that, we will deliver our official inspection report, the final verdict. So let's kick things off with Section 1, the sweet headline beat. Right now, we are inspecting that impressive curb appeal. We're talking about the powerful top-line numbers that blew past Wall Street's expectations and generated all those positive headlines. This is the very first thing every investor sees. And I'll admit, on the surface, everything here looks spotless. It looks immaculate. The numbers are huge, the beats are clean, and that initial impression is one of just undeniable strength. But let's take a closer look and see what these numbers are actually built on. First up, just look at the raw force of that top line. Hershey reported Q4 revenue of $3.09 billion. Now, that didn't just meet expectations. It completely smashed the $2.98 billion that analysts were calling for. That's more than $100 million to the upside. In this kind of economic environment, that represents a solid 7% year-over-year growth. That is a very strong signal. From a distance, I agree, it looks like a rock-solid, well-constructed wall. It really is the kind of big, bold number that builds immediate confidence and makes all the trading algorithms just start buying the stock. But maybe a little too immediate for my taste. Let's keep digging. And the picture just gets sweeter as we move down to the bottom line. Adjusted earnings per share, or EPS, came in at $1.71. That's an incredible 21.8% beat over the $1.40 estimate. Let's be really clear here. For a mature, blue-chip consumer staple company like Hershey, beating earnings estimates by almost 22% is, well, it's almost unheard of. It's a massive surprise. And when a company this big delivers a jolt like that, the market absolutely sits up and takes notice. It's another perfectly placed brick in this company's facade. A beautiful, shiny brick, I will give you that. But my question hasn't changed. What kind of mortar is holding all of this together? A beat this large, it feels less like organic fundamental strength and more like some kind of clever financial engineering. I'm still asking myself what is really holding this whole thing up. Okay, but hold on. This right here, this is where I really start to have some serious questions. It's not just about the Q4 beat. They didn't just have a strong finish to the year. Their guidance for the entire upcoming financial year also blew right past what anyone was expecting. Their midpoint guidance for 2026 earnings is almost 18% higher than what analysts had modeled out. So let's just recap for a second. You've got a solid revenue beat, a gigantic earnings beat, and blowout forward guidance. It all looks fantastic. Honestly, it looks a little too fantastic. What is actually holding this structure up? Are we looking at solid fundamental growth here, or is this just some clever financial architecture designed to look good for one quarter and trap a bunch of unsuspecting investors? We've got to look deeper.
That is exactly the right question to be asking, and it leads us straight into Section 2, cracks in the chocolate armor. It's time to move past the fresh paint and the pristine curb appeal of those headline numbers. We're pulling out our tools now, and we're going to start tapping on the walls and examining the very foundation and framework of this business to find any potential structural weaknesses.
Okay, this table right here, this single slide reveals the first major crack in the foundation. This is probably the most crucial slide in this entire section. You see that top line, organic sales grew a healthy 5.7%? Good. But the critical question is, how did they get that growth? The answer is spelled out right there on the second line. Net price realization, which is just a fancy corporate term for price hikes, was up a staggering 9%. And now, right now, we get to the absolute heart of the matter. The most important line here is that last one. Organic volume/mix was down 3%. Just let that sink in for a minute. Their growth is coming entirely from charging their customers more money while at the same time selling them less actual chocolate. This is not a strong, sustainable foundation for growth. It's a foundation that's built on pricing power alone, and believe me, that can become brittle very, very quickly. So what is this volume decline, combined with all the other inflationary pressures, doing to their actual profitability? What's the real stress load on this core structure?
And here is your answer. You just hit on the critical failure point. The stress on this system is immense. This slide shows that Hershey's adjusted gross margin fell by 650 basis points year over year. For a company of this scale, of this maturity, that is a catastrophic decline. It's a clear, flashing, red warning signal that even though they jacked up prices by 9%, their input costs are rising even faster. This tells us the core profit engine of the company, the very furnace that forges their earnings, is under severe and significant strain. And this slide right here brilliantly illustrates the specific forces that are cracking those margins wide open. It is a perfect storm of headwinds. You've got the elevated cocoa and other input costs that have been just hammering the entire industry. On top of that, you've got about $30 million in tariff expenses, add in the lower sales volumes we just talked about, which means they have less leverage over their fixed costs, and finally, some arcane inventory accounting headwinds. But the most crucial point, the one that every single investor needs to understand, is that final note, which comes directly from their earnings call. The price increases they push through in 2025 do not fully cover the expected cocoa inflation for 2026. Management themselves are telling you this is not a simple fix. They are on a multi-year recovery path, which is just corporate speak for a long, difficult, and very expensive renovation. But this is where the story gets much more complex, and frankly, a lot more interesting. Let's move to Section 3 and see how this all builds, the salty steel reinforcement. So while that original chocolate foundation has some very serious, undeniable cracks, Hershey's management has not just been sitting on their hands. They've been actively constructing new reinforcements, strategically adding new, load-bearing structures to the business to shore up the entire enterprise. This bar chart tells the entire story in one single, powerful image. On the left, in that first bar, you have the North American Confectionery business, the core chocolate brands, growing at a respectable 5%. That's the cracked foundation we were just examining. But now look at the bar on the right, North American Salty Snacks, organic growth of 18.2%. This isn't just a minor addition. This is an entirely new wing of the building, and it is posting explosive, almost venture capital level growth numbers. And the crucial point here, once again, is the how exactly. This wasn't just about raising prices to mask some kind of weakness. The source data shows us that the Salty Snacks division's growth was driven by a stunning 14% increase in volume. Consumers are actively going out and buying more Skinny Pop popcorn and more Dots pretzels. It is the polar opposite of the dynamic we're seeing in the core chocolate business. This is real, fundamental, consumer-driven demand. Okay, I see it. The reinforcement is impressive, I'll give you that. Skinny Pop retail sales are up over 8%. Dots Homestyle Pretzels has grown so fast, it is now the #1 pretzel brand in the entire country. Even Pirate's Booty is back to positive growth. It's a strong list of accomplishments, no doubt. But here's my skeptical question. Is this new wing of the business, this Salty Snacks division, truly strong enough to support the entire corporate structure? If that core chocolate foundation continues to weaken under margin pressure and declining volumes, can this new division really carry the whole load for the long term? I mean, is it a permanent structural fix, or is it just a temporary support beam that's propped up against a crumbling wall? That's a fair and a critical challenge, and management's answer to that very question lies in their blueprint for the future. So let's move on to Section 4, Forging the 2026 Outlook. It's not enough to just see the current state of the building. We need to analyze the plans they've laid out for the coming year to see if they're actually building on solid ground or just on wishful thinking. Now, before we can properly assess their forecast, we need to understand a key architectural principle they're using in their planning: elasticity. This is a critical concept. It simply measures how much your sales volume drops when you raise your prices. On the earnings call, the CFO, Stephen Vosquell, was very, very clear. He stated that for 2026, the company is planning for an elasticity of 0.8. What this really means is that for every 10% they hike prices, they are conservatively assuming that their sales volume is going to drop by a corresponding 8%. Now, here's what's really interesting. He also stated that the actual, current trends are more favorable than this assumption. In other words, they are building a cushion, a margin of safety, directly into their plans. This suggests a prudent, well-thought-out blueprint, not a reckless one. Prudent planning is good, but no blueprint is ever perfect, and no construction project ever goes exactly as planned. Every single project faces unforeseen challenges. So what about the potential storms that could hit this company? What are the external risks, the potential macroeconomic headwinds that could come along and really test the durability and the integrity of this entire 2026 plan? Management addressed these risks directly on their call. As you can see on this slide, they're monitoring the primary threats. First, cocoa price volatility. Now, they are hedged for 2026, but the future beyond that remains a significant unknown. Second, the health of the consumer. If the economy weakens, are people going to cut back on affordable treats like chocolate? It's a risk. Third, you've got SNAP waivers. These are policy changes that could affect candy eligibility. Management acknowledged this, but they called it a manageable headwind. And finally, competitive response. What if Hershey's rivals see these high prices and decide to start a price war? Management's public position is that they see these storms on the horizon and have already factored them into their guidance. They believe the structure is built to withstand them. All right, we've inspected the impressive curb appeal. We have tapped on the walls, and we found some pretty significant cracks in the foundation. We've analyzed the new steel reinforcements, and we've reviewed the blueprints for the future. It is now time to weigh all of the evidence. Welcome to our final section, Section 5, the final verdict. This is the official Iron Financial Inspection Report. So it all comes down to this core tension that you see right here on this slide. The bull case, the opportunity, it's clear and it's powerful. They've got proven pricing power, absolutely explosive growth in that salty snacks division, confident 2026 guidance, and the simple fact that they own iconic, resilient brands that consumers genuinely love and trust. But the bear case, the trap, is just as compelling, and you absolutely cannot ignore it. Those negative volume trends in the core chocolate business are a massive red flag. The severe gross margin compression tells you that they are seriously struggling with costs. They are almost completely reliant on price hikes just to show any top-line growth at all, and they remain heavily exposed to commodity volatility and a potentially weakening consumer. But that salty snacks growth proves that the company can adapt and find new load-bearing structures. It shows that they can innovate their way out of a tough spot, and that is the hallmark of a quality company. Those are not minor cosmetic issues in the core business. Those are fundamental flaws in the main structure. You can't just ignore a crack in your foundation because you built a nice new garage next to it. The entire structure has to be sound for the long haul. So, after weighing everything, here is the official Iron Financial verdict. Hershey is a sweet brand with a very salty problem. The foundation, that is, the core chocolate business, shows clear, undeniable cracks from margin pressure and declining volumes. We cannot and we should not ignore that. However, the steel reinforcements from the salty snacks division are real, and they are proving to be load-bearing. This is not a company that's on the verge of collapse. It's not a house of cards just waiting for a strong gust of wind. Exactly. This is not a teardown, it's a renovation project. The original structure needs significant work, but the new additions are strong, they're growing, and they appear capable of supporting the business while the necessary repairs are made. As always, you must do your own homework and forge your own path. And for those of you watching this company closely, circle March 31st on your calendar for their upcoming Investor Day. That's when we expect to see the really detailed architectural drawings and the blueprints for this ongoing renovation. You can be sure we'll be watching. Thanks for joining us on Iron Financial.